Okay, so I believe we are live. Something looks wrong on my end here, but I recently did a full system recovery on my computer just a few days ago, and it does seem like some of the settings are looking awfully different. So definitely shout at me if it's wrong. I also noticed I don't even have my intro set up, so, complete disaster right from the start, but we don't really need an intro. We can just jump into things. So I'm just going to go ahead and assume that everything is all good. I can see myself, and I can see there's at least one question coming in. So, all right, shout at me if something's wrong. But thank you very much for everybody showing up and hanging out. We've got a pretty good show today, and got a rundown here. We're just going to go over two quick things, and then, of course, we'll get into the Q&A as we always do. So I do want to touch on the whole idea of how volatility strategies would perform in a significant recession, something like 2008, for example. It's actually been quite a long time since something like that has happened. There's been some downturns and some crashes, of course, but nothing that really stuck around too long. So that's always a big question, whether people are wondering, well, short volatility seems to work fine during a bull market, but sure, the big fear is that something will obviously break during a bear market. So we'll get into that. And then the second thing, I thought now would be a good time to update that trade that we have constantly going. About a month ago, I guess, what was it, August 3rd? So almost 2 months ago, we did a live stream and we opened up a couple of live trades, and we're going to be pitting them against each other. And I've got the results. They are not surprising to me. This is kind of why I ran this experiment, but I will recap what we did there and declare the obvious winner. So not going to give any spoilers, but if you've been following my content, you probably know which one actually ended up winning. So third one, of course, open Q&A. We always do that. Open to everybody. Don't super chat or anything like that. This is episode 92, so we are actually closing in on episode 100. I will try to finish those out before the end of the year, of course. And another thing, just quick before we get into this, we are actually within reasonable striking distance of 30,000 subscribers on YouTube as well. So for a fairly niche little segment here for the short volatility trading, that's pretty good. It's a kind of a goal of mine to get to 30, and then obviously eventually 50, and maybe get that. What is it? Gold? No, gold is for 1 million. The silver YouTube play button, which would be 100,000 subscribers. So help me out. Subscribe to the channel. About half the people that watch my content aren't actually subscribed, so that is free. Just go ahead and click that subscribe. Of course, hit the thumbs up as well for me. YouTube loves that for some reason. And yeah, let's get right into it. So like I said, the tactical volatility during 2008. And the obvious reason why we have to go over this is hopefully by now, and I've done quite a few videos and 300 videos or something, lots of articles on the website, hundreds of hours of live streams. Hopefully I've contributed to everybody sort of getting more comfortable with the short volatility trade. Of course, we know that, while it's not always the case, the short vol trade, so to speak, can do quite well for extended periods of time, especially during calm markets. The VXX, for example, the original gangster of the volatility space, it progressively goes down. About 85% of the time, it has a headwind, and it's going to be decaying downward. So there's no question at this point, most people are obviously fairly convinced that the short vol trade works, but the big fear is what is going to happen during a recession. So we are going to actually go through some numbers. Now, really quickly, we have to explain, first of all, I'll explain why I personally am never worried about market crashes. And if you follow my work or if you do something similar with your own work, then you shouldn't be scared of them either, right? The goal of investing is to always be allocated so we can participate in the markets when they're going up, because most of the time, as we know, markets do go up. Being bearish, being a contrarian, that's just not going to make money. You have to participate in the market when it's going up most of the time. But of course, the big problem is that the vast majority of people are net long equities and they somewhat stay that way. And so market crashes cost everybody their money. They do well for 5 or 10 years and then they give a big chunk of it back. So we definitely want to avoid that. And what I personally do, and you've probably heard me say this, but volatility targeting is how I make sure that I'm cycling into the safety positions at the right time. So let's just very quickly check out what I'm talking about with respect to that. So we're going to be talking about our tactical volatility strategy today because all of the metrics that I use within the strategy, they are available going back to 2004. Our defensive rotation strategy, for example, defensive rotation has some of the metrics that it's using that were not available. So I cannot drag a backtest backwards. VTS launched in January 2012. I'll show you the live results from this, but I can also quite easily just drag a backtest back. So it works really well. But essentially what we do is we're mining volatility metrics, and during stable markets, of course, that is the time to attack. That is when you would be long equities, you would be short volatility, and we use the SVXY currently. So in the past, I've used the XIV from 2012 to 2018. I'll get into that in a second. But right now we're using the 0.5 leveraged SVXY. But of course, when volatility elevates, it's going to be giving ambiguous signals where you're not really fully in, you're not fully aggressive, but you're also not going to actually overtly short the market either. So that safety position is when we go into gold. Now, gold itself is not a very good buy and hold vehicle at all. Nobody should be holding gold long term. But during this very narrow band of mid to high volatility, gold actually performs quite well. And then on those rare occasions during a full-on recession, something that really scares the market, roughly 3% of the time, we will be long volatility. And I always choose the VXZ. It's a little bit slower moving product because it is in M4 to M7. So that means it's playing in the midterm futures. The front end of the VIX futures can move quite quickly. And if you're using something like the VXX or certainly UVXY, you can lose a lot of money very quickly with those products. But we use the slower moving, more watered down ones, and it just performs much better. So that's the strategy. That's what I mean by volatility targeting. Based on where the market is telling us we should be, we're going to be in one of those positions. And because of that, that's why I will never be scared of a market crash. A lot of people, their biggest fear is that, well, what happens if this all ends? Well, all that happens is within 1 day notice, if it's a significant volatility spike, we can move our entire portfolio out into safety. So really, there's no reason not to be allocated and feeling confident and aggressive during the times when the market is telling us we can be that way, because we know I don't have to ride the stock market down for multiple years. I don't have to be in a drawdown for 6 or 7 years. We can just cycle out into safety. And if it gets bad enough, maybe we can even profit from it. So that's why we're talking about this today. Now, strategy itself, I'm going to be showing this. I want to make very clear. This is a backtest. This is the underlying spreadsheet for my strategy. And the reason that I'm showing a spreadsheet, there's a couple reasons. One, it's actually very easy to change the thresholds. So anytime somebody asks a question, they say, well, what if you wanted to be a little bit more conservative? Maybe you only wanted to short volatility in a more narrow band. What would that look like? And then the other thing is we can substitute in and out any ETF, any asset class, and I can always show that. So if somebody said, for example, well, what if you used utilities instead of gold? If you use it a spreadsheet, it is just a simple matter of substituting in and out. Now, the reason that I can do that, I just want to make it clear that our live performance is actually better than the spreadsheet by about 10% annual return better. So when I'm showing a spreadsheet, I don't want people thinking, oh, he's just showing this back test and it's not actually real. Our live trading launched in 2012, and it is significantly better than the back test that I'm showing. But it's just so much easier to work with a spreadsheet. So that's why I was showing that. Now, the big question is, this is the strategy because, like I said, we launched right about here. We launched live January 2012. So great performance, but we really want to analyze what happened back here, and that's where the back test comes in. It's basically the exact same thing. It is a full walk forward. I'm not using any look back bias. The reason it's a little bit choppy in the beginning is because it's actually when you're doing a full walk forward, which means I don't know what the signal should be until I've got enough data to actually filter out the percentiles. So you can see it underperformed a little bit at the beginning. That's just because I don't want to cheat and just use a full look back bias. So this is a full test as it would have been in 2004. And the results, just kind of keep these numbers in your head. About 31% return, 33% drawdown. Compare that to the S&P 500. Of course, we're looking at 3 times higher return with almost half the drawdown. So significantly better. But now let's analyze the big question everybody's wondering. What about before we launched VTS? So this is what the strategy would have looked like had we launched, had I known how to do all this and had the volatility ETFs actually existed. This is sort of an imaginary world. It is just a back test. But you can see, results-wise, it's actually about the same. There's really no difference here. So for our strategy, pre-launch 2012, this is 2004 to 2012, and post-launch for the next 13 years, basically the same strategy, the same performance. The idea that the short vol trades, it was only good for a couple of years and then it fizzled out, or it's dead now and it's not coming back. You hear these things all the time, but I can just look at the 20-year results and see that as long as you know what you're doing, the volatility risk premium, the volatility metrics, the underlying reasons why shorting volatility, it has worked for, decades, and there's no reason why it wouldn't continue to work. Underlying volatility is actually the reason why we can target the right asset classes. So all we're doing is just capitalizing on a little bit of that inefficiency, where obviously the traders are going to have to get paid a premium to be taking on forward risk. This is what a market in contango is like. And so there's no reason to expect that this is going to be any real significant differences, better or worse over time. It is what it is. You'll get good years and bad years, but through larger chunks of time, like 10-year periods, you should notice a lot of consistency. And that's what this is showing. So, and then compared to the SPY, obviously this is the financial crisis. So the SPY was terrible, and it actually took quite a while to recover from. I can show that. I don't think this is a fully updated chart, but you can see here's the financial crisis right there. And it actually took a full 6 years. It took to 2014, inflation adjusted almost to 2015 before it broke even from the 2008 crash. So this is, like I said, you really don't want to be the type of trader that has a great time during bull markets. You think you're doing well. You start planning your household budget. You get a house. You've got the kids. You've got the mortgage. Start socking away money for your kids' college fund. And you're kind of doing this under the sort of the guise of a relatively decent market performance. And then all of a sudden you get hit with a 7-year drawdown where not only are you not making any money, but maybe your net worth got cut in half. If you're a normal investor, that's typically what happens, 30 to 50% down, and it might take you several years. So you don't want to be in that situation. You definitely want to, I would invite people to look at my work a little bit closer and figure out why we're doing what we're doing. It's mainly, we have significantly outperformed the market in the last 13 years since we launched, but the primary goal is capital preservation and potential profit in a down period. So that's why that chart here is actually really important. So now what we're looking at, hopefully I'm using the screen share correctly, but now what we're looking at is just that period from 2007. So this is basically the end of December 2006 up to the end of December 2009. So this is a 3-year period. And now we can really see that the cost of the financial crisis to the underlying S&P 500. You can see it's negative for those 3 years, and obviously a huge drawdown. Nobody, I wouldn't say nobody, but nobody who has any self-preservation can actually buy and hold the S&P 500, knowing that it's going to suffer a 50% drawdown at some point. It has before this, it will in the future. I don't know why people promote buy and hold. What ends up happening 99% of the time is people think they're going to buy and hold because they're looking at a 30,000-foot view and they think, oh, the market always recovers. But inevitably, emotion is involved when you are in a 50% drawdown, and nearly everybody makes mistakes during the crash, and that's where you lose all the money. So buy and hold is a non-starter, but we don't need to do that buy and hold stuff. We obviously can just cycle in and out of the best positions and ride out the downturns, which are much shorter lived. Now, one thing I do want to point out, a lot of people don't know this. It always surprises me when we talk about the financial crisis. A lot of people don't know. They think that the financial crisis started when Lehman Brothers basically collapsed, right? September 2008. That's when everything really started to get bad. But what people don't remember is the S&P 500 was down almost 20% for the 18 months previous to Lehman Brothers collapsing, right? Starting in, October, September, I think October 5th actually was the peak. So we're talking about almost a year period where it was down significantly, and then it fell off a cliff. And this period is interesting because it would have been very difficult to trade. Even if you were a tactical investor like I am, there would have been a lot of false signals and a lot of bad situations where you're very regularly getting caught between these thresholds. The market's not really making a full commitment either direction, and that's when you get what we call whipsaw. So a lot of whipsaw for that 1 year period. This strategy didn't do a whole lot better than the S&P 500, but you can see once Lehman collapsed, everything kind of takes off. That's when we would, of course, get the signal to go long volatility, because really, this isn't some crystal ball thing where I'm just kind of hoping that that's what happens. This is almost a definitional thing. Like, volatility is almost by definition classifying the market crashing, right? It would be literally impossible for the market to go down in an extended recession for multiple years and not have volatility at least breach into the top 1/3 of positions. Maybe some miracle happens and it doesn't go into the top 2%. I still think obviously it would. It always has and it always will, but certainly into the top third. So at the very least, we'd be looking at safety positions. So I don't want people to think, oh, well, this is just crystal ball timing this perfectly. How does he know it's going to happen again? Well, at the very least, we'll be here. And very likely we'd be bouncing around between these two. But that's the point, is that you really do need commitment from the market. And then as soon as you get that commitment, that's when you can really start to make a lot of money. So when everybody else is crashing and, crying, watching their portfolio collapse, don't mean to make light of it. I know that would be terrifying and scary. I've had my period of losses as well in the past. But yeah, that's when things can get a lot of fun. So if it's an extended recession, I'm not actually that worried about it. And I always caveat this by saying, full disclosure, I will not be happy when there's a market crash. There will be, maybe in the next year, maybe in the next 5 years, it's going to happen. So just mentally and financially prepare for it. It's going to happen. Nobody knows when, but it would be foolish to think we're not going to get another extended recession. The COVID thing, that was just down and right back up. $6 trillion spent by the government and the Fed, and then boom, the market's fixed. Well, that's not always going to be the case, trust me. So when it happens, people get hurt. Right. So I don't want to be that person that's cheerleading for a market crash. Recessions are terrible. It hurts the average person. It hurts low income people the most. It's a disaster for the economy. And so I'm certainly not going to be smiling and cheerleading. But on a personal sort of just purely selfish financial reasons, market crashes are actually an opportunity if you know how to do this stuff, if you know how to cycle out into the good positions and do it responsibly. So, again, I don't mean to be that guy that's like, oh, I hope the market crashes. I hope everybody's crying, watching their money burn. No, believe me, I'm not that guy. But that is essentially what we are talking about. So strategy itself, again, starting here, pretty consistent, but really this is just a function of pure volatility targeting, being in the right positions. We get it wrong too. That's another thing too I could point out, that there actually is an argument to be made that there is quite a similarity between what happened in 2007 and 2008 before the market crash, say right about there, and 2022, what we saw recently. 2022 was a very frustrating year, especially for somebody who trades the way that I do, which, like I said, is volatility targeting. If you're constantly getting caught between these thresholds, it actually can be frustrating, right? This is what I always say, that there's no free lunch in investing. There's no strategy that does well all the time and never has a bad year. Like, that's just impossible. Anybody who thinks that, like, yeah, there's a million people on Twitter who say that that's what they do, but no, everything goes through difficulties. And 2022, much like 2007, 2008, markets were down 20%, but volatility never really spiked. It never gave that full commitment signal. So problematic for me. I had a negative year, wasn't a lot of fun. We've obviously cleared our high water mark. We're at all-time highs again, but that's not fun. And it has actually, there is precedent for that in the past as well. Now, this time around, after 2022, we didn't get Bear Stearns and Lehman just go, off a cliff, but we could have, and perhaps next year we will. But that's the point, is that hopefully I've shown you why I'm legitimately not afraid of being allocated in the market. I go on Twitter and I just constantly, every day, just see a stream of people saying like, oh, you guys are fools to be allocated. You're crazy. This is going to fall off a cliff. The house of cards is going to crash any minute. The Fed is going to break the market. Why are you allocated to stocks? Why are you doing this? Well, for me personally, I'm not buy and hold. My whole portfolio can go to safety in one day. Why wouldn't I be allocated today? The S&P is at all-time highs. Maybe on Monday I cycle out into safety and Tuesday is the start of a market crash. I don't know. Who knows? But I do know that with volatility targeting, we can just be constantly allocated. There is no reason to try to anticipate, okay, when is this crash coming? I know it's coming. Maybe I should sell next week, or maybe at the end of this year, that's it. I'm pulling the plug and I'm out. No, I'm going to be investing right up to that edge, during it and after it, the entire time, fully allocated. I just won't be allocated to aggressive positions. I can flip it upside down and actually make some money. So there you go. For anybody who was wondering, financial crisis, is it the end of the world for short vol trading? Probably it is for 99% of the Twitter traders, but it won't be if you actually have a real strategy that can get you to safety. So, yeah. So there's some questions coming in. I did want to recap those trades, though, because this is actually quite interesting. So where this is coming from, let's go on to point number 2 now. And where this is coming from, let's just really quickly plug my YouTube channel again. That's always fun. Get some plugs going. About 7 weeks ago, this one here, the 2024 market crash has begun. This was on August 3rd when we did that. So August 3rd is actually, here's August 2nd, and this is the 5th. We actually did a Saturday live stream right here when the markets were going crazy. And what we did in that live stream was we opened up 3. One of them was not interesting. We opened up 2 trades, a long put option on the VXX and a VXX Put Butterfly. And the point is that when markets crash or spike like that, volatility spikes, market crashes, everybody has that idea that they're going to buy long put options on the VXX or the UVXY, if that's your vehicle of choice, and they're going to make a bunch of money when it eventually goes back down. Because, I mean, who at this point doesn't know that it's eventually going to go back down? We all know that, right? There's VXX, here's VIXY, basically the same product. UVXY, these things, I mean, depending on what leverage factor you use, it's definitely going to go back down. So when you get to no, not that one. Let's open up this one. When you get to a point where you get a massive spike, this is when people think, I've got it. Long put option on VXX. Now, the reason that this is not going to work, and I explained it in that live stream, but just super quickly here. Wow, I got a lot of windows open. Bear with me. Okay, the reason that's not going to work is because options trading is a little bit more dynamic, of course, than option trading. We've got price, time, and volatility to deal with. So a long VXX put option is what's called long vega. This means that it is very sensitive to volatility. If volatility goes up, then the option will actually gain value. If volatility goes down, the option loses value. And this is what tricks people up. And I think why it happens, I've actually had to explain this every single time the market crashes, every time. Somebody or 10 people or 20 people will email me. They'll say, I bought a long VXX put option. I bought UVXY puts. What is going on? Like, is this machine broken? They're not paying me out. I'm still flat. I'm down money. What is going on? I think this is happening because if you go on Twitter, you get all these option traders, right? These option gurus. They're not really option trading, are they? They're basically just speculating on stock prices, and then they're using option contracts to represent that trade. So maybe they think Apple's going to go up. The iPhone's coming out. They think it's going to be a big success. Oh, let's buy long calls on Apple. Well, you're technically trading options. I mean, a long call option on Apple is an option, but actually what you're doing is you're speculating on the price of Apple. You're not focusing in on what makes option trading so cool, in my opinion, is the fact that it's multi-layered, price, time, volatility. There's all the Greeks. They're not looking at theta, vega, gamma. They're not doing any of that. They're just saying, I think Apple's going up, long call option. Look at me, I'm an option trader. Well, no, you're not. So I think that's where it's happening, is that people think, oh, when something is going to go down, long put option. When it goes up, long call option. But this is obviously completely broken and wrong because that's not how options work. There is something called vega. So what ends up happening with a long put option, if the VXX, and this is the VXX, if it does go back down, well, what's going to end up happening? You will literally be correct on your price direction. That's called delta. You will have got the delta correct, but the vega is going to absolutely destroy you, right? You bought an option with a very high vega right here when volatility was at its peak, and it's going to cost you a fortune to open that contract. And then when it declines, when you're right, and you're looking around for people to high five because you think you should make a bunch of money, the vega actually costs you more money than you made on your delta. So now let's get into the actual trades. So the one we're talking about first is this VXX put option. Now, we opened it when it was in the 60s. It was over here, and it has gone all the way down to here. And what has happened? You can see this trade. We spent $600 on this trade. It is negative, right? What we expected to happen, and actually the VXX has crashed even further than I think a lot of people maybe thought. It crashed down pretty hard, and there was a time about 3 weeks ago when it was a little bit profitable. Maybe right about here, it was slightly in profit range. But the general point applies that the faster it goes down here and the more right you are on the direction, the more wrong you are on the vega. If we highlight vega, look at how positive this number is. It's way up here. So this is going to get absolutely crushed when the VXX goes down. And now here I am sitting in a trade that I got directionally very correct. I'm down over 50% on this option contract, right? This is what happens. This is why I get so many emails of people complaining that their put options aren't working because they bought it at the perfect time. I literally bought this here, all right? And I actually bought more here for another private video, and that one's down just as much. It doesn't matter how high it goes because it's a relative ratio. The higher it goes, the higher vega goes, the more expensive the contract gets. So you don't have to top tick it. It doesn't matter. Even if you get it to the very top, who cares? All that means is that's also the very most expensive possible peak for the option contract to begin with. So it doesn't matter. People think that the reason it's not working is I didn't quite get the timing right. No, any one of those days in the 5 or 6 there, it's all the same thing. It's a relative ratio that's going against you. So now let's talk about what I said would be a far smarter trade to get into. And that is one of my favorites. It's called a butterfly option. Now, a butterfly is a more complex option spread. It is 2 outside long strikes and then 2 short strikes in the middle. And this is what makes it such a great trade. Because if there's 2 short strikes in the middle under this umbrella of a butterfly option, that means that it's actually a short vega trade. It is a short volatility trade. Now, it is also short delta because we were directional. We opened it when it was over here, and we put the trade over here because that's where we knew the price was going to go. Obviously, I mean, outside of a really extended recession, it wasn't overly difficult to know that the VXX would be somewhere over here a month later. And that's exactly what's happened. The VXX is actually sitting right there. Let's just make this as obvious as could be. This is our trade. Now, this trade, we tried to make them both 500, but we couldn't. I spent 434 on this trade, and it's up 462, 470. So it's over 100% profit. The long put option was down over 50%, and this one is up over 100%. This is what happens when you are a more smart option trader. Because if we look at our Vega, under the umbrella of profit, this is a Vega negative trade. This is a very good thing when you're getting into a trade during an extremely expensive time to be buying options. You don't buy options, you sell them. And you can see the short strikes, the double up is the 46. These are the shorts. That's what makes it short volatility. So this trade was very successful, and I could roll the dice and let it keep going. Maybe it decays more, but I mean, making over 100% on the trade, it's done its job. And just a reminder, this is just our live stream account. I also take trades in my actual long-term portfolio. I just keep a little bit of money in this account so that if I accidentally show my account, it doesn't really matter. I mean, I've shown account values, account numbers, thousands of times. I just don't want to be worrying about where I'm clicking and all that stuff. But yeah, I've already closed down my main trade for this, and I made far more than $500. It was a very successful trade because we took a short Vega trade when volatility was at its peak. That is essentially option trading. It is price, time, volatility, all the Greeks. You don't have to know all the charm and color and D Vega, D time. You don't have to know the advanced stuff, but certainly the main four, gamma, theta, Vega, delta. And if you take them all into consideration, you will very quickly realize that when volatility spikes, that is the worst possible time to be buying long put options. But for some reason, and I swear it's Twitter traders doing this, there is just way too many people buying put options when they just shouldn't be, right? It's the same thing as on the flip side. What happens if the market goes down and somebody says, oh, I think the market's going to reverse, right? So maybe I should buy a long call option. Why? A long call option is a long Vega trade, right? You're not going to be doing very well with that position if you traded it at that time, right? It's just option trading done successfully might actually be counterintuitive to what people are saying, and it's certainly counterintuitive to what people are teaching online. So I will, of course, be very quickly and diligently be trying to return our VTS options community. For anybody who doesn't know, we used to have two communities, kept them kind of separate, and I just got too busy. I was a one-man show here at VTS, so I had to choose one, and I basically kept VTS going. But I have streamlined a few systems behind the scenes, and I've hired an editor. Hopefully people have noticed maybe a slight improvement in my video quality coming through. And so it does appear like I'll have a little bit more free time to bring back the VTS options community. And yeah, that'll be a good thing because there's just far too many people losing money trading options when all they're really doing is not trading options. They're just speculating on stocks. I mean, anybody can do that. Just buy the ETF. Just buy the stock. Forget about the option. You're just adding elements you're adding extra variables unnecessary. Option trading is for people who really want to dive in and figure out, okay, I short things that are expensive and I buy things that are cheap. It's not about direction. It's about Vega, theta, things like that. So there you go. Successful butterfly, wild, huge failure on the VXX put, just like I predicted. So if you want to go back and watch that live stream, it was it was that one that says market crash. Pretty fun stuff. Every time the market crashes, I do live streams. So next time around, we can brainstorm some much better trades and actually get you making some money like I did. Not to brag, but I knew it. I told you if I didn't know the VX was going to go down, but if it does go down, I knew 100% that the butterfly was going to be the winning trade. So yeah, let's dive into the questions. Okay, there aren't that many. People are probably. I took a few weeks off. I don't know. I also didn't blast this out to the normal community. I just kind of neglected it. I think I forgot a few things. Okay. Hold on a second. Why is that black text? See, I did a full system recovery, so I might have to fix this on the fly. Bear with me. Let's see if I'm tech savvy at all. How's that? How's that? Well, now it's gone. Oh, it's probably gone because it timed out. Everybody can see that a little bit better. I'll make these a little bit nicer. My old one had a little spinny thing going around it and all these graphics. This looks very boring, but as long as you can see it. So with so much happening in the Middle East, will today's session be quick? Well, there's an insane amount of things happening in the Middle East, scary things, terrible things. I don't know how that affects the pace of my live stream, but it certainly affects our mood, and hearts go out to everybody on both sides. Obviously, you got to be careful when you talk about things like this because it's very polarizing, and for some reason, people have a very difficult time seeing things from both perspectives. So in this hyper divisive world of social media that we've created, and to be honest, destroying the world that we used to know very, very quickly. I'm old, so I'm Gen X. I was born in 1975. I didn't have a cell phone till university, and I remember what the old times were like. I remember what the before times were. But yeah, it just seems these days you can't even give an opinion without people they think that, oh, he said these 7 words, so that means I know everything there is to know about this person's entire existence, right? All I have to know is one sentence regarding the Middle Eastern conflict, which side you fall on, and I can just summarily dismiss this person for the rest of my life. This is what social media has done to us. So I would just prefer to stay out and just say, like, come on, stop the madness. It's so terrible. It's just hard to even parse through it all. So, but yeah, we'll keep pushing on with our individual lives. That's what all of us. That's all any of us can do. Is just at the end of the day, we've all got to be a little bit selfish and just make sure that we and our friends and families are being taken care of by us. Like, I've got responsibilities, and that's all I can really handle, right? I just make sure that my little team here is doing just fine. And I hope everybody else is doing the same. I hope, that doesn't mean you can't be compassionate and maybe even involved, maybe even up to date and following the news. But at the end of the day, got to be selfish, got to take care of your own little tribe and just wish the best for everybody else. I hope it gets resolved very quickly in a way that is some form of a step in the right direction for the future, and that we just don't end up back here, 12 months later. It's crazy. All right, given that VXX is designed to decay over periods of time, okay, I'll let that pass. Usually people talk about the manipulation and it's designed to steal our money. The way you worded this, acceptable. Designed to decay over periods of time, yes. What would you say how high it can go before we get a market crash like volatility? So good question. There is no levels, right? I'm not punting on your question. There literally is no levels. You could go, for example, 2016, March 2016, all the way to February 2018 Volpocalypse, total calm, right? Super low volatility period. And in that respect, VXX can go very low. If you got a period like, the pandemic and whatnot, it can spike up extremely quickly. But it really depends, like you're asking how high it could go, how low it could go, how long it's going to go before the next spike happens. This is all dependent on the markets. There are times when you get 3 market crashes within a 3-year period, right? We had Volpocalypse 2018, Q4 2018, like 7 months later, the markets crashed another 20% again. And then it wasn't 2 years from then. Well, actually, it was only 13 months from then. We had the pandemic. So in that respect, volatility has been in a major drawdown for a number of years because you had 3 just back to back to back, killing vol. But there are other periods where you get 7 good years with just 2 very short market crashes. So unfortunately, no answer. I see people try to quantify this. They try to say, well, okay, on average, every 16 months, there's a 30% spike, and every 24 months, there's a 75% spike. It's all totally meaningless. These are just little things people throw out on Twitter that seem clever. It doesn't help your trading one little bit to know those things. Like, what is the average before a 50% spike? Well, what does that even mean? If you're a person trading in 2017, it's irrelevant because you're you're about to face 3 quick succession market crashes that's going to throw all your statistics completely off, right? If you're a person just leaving the China financial or the China hard landing thing in 2015 and you think, oh, it's going to be 16 months and then vol will spike, well, maybe not, right? Maybe it's going to be a whole lot longer than that. So I just don't worry about that. Everything that I do is mining the data to be as accurate and up to date as possible for today. I'm not trying to front run anything. I don't know what positions I'll be in on Monday. I just know what I'm in today. Friday's trades, right? I go into my spreadsheet, I enter all the data, and I decide the best trade for just today. And then on Monday, about an hour after the market's open, I'm going to go in, I'm going to do all my data again, and I'm going to decide what is the very best position to be in on Monday at that time. At 11 a.m. on Monday morning, what's the best position? And then Tuesday, I do the same thing. Wednesday, I do the same thing. So, of course, we don't cycle out every single day. I'm not saying I'm a day trader. If we're in the same position for 6 months straight, then we just leave it on. But I do check every single day. And none of that is, well, I think, it's been a little bit too long. Maybe volatility will spike. Maybe I'll front run. We don't do any of that stuff. Trying to predict markets rather than just use data to give you the actual signals, it's a terrible idea. And using averages and long-term spikes and it hit 50% here, so that means it's going to Fibonacci down here. It's all nonsense. Hopefully there was an answer in there somewhere. Okay. Have you talked recently about the vol drag of a position like TQQQ at a smaller size, but putting the extra capital into SHY? Yes, exactly that position. It was inspired, probably much like you are wondering. So for example, our defensive rotation does use the 2 times NASDAQ QLD. But for people who have lower risk tolerance, right? Nothing wrong with that. The NASDAQ itself moves plenty to make a profit during good times, so they can use the Qs. So the question is, well, if you're using, let's say, $100,000 of the Qs, 1 times leverage, $100,000, why wouldn't a trader just use 1/3 of that money, $33,000, and buy the triple leverage TQQQ, and then put 66% of their money in short-term treasuries that are paying 5% a year? Why wouldn't they do that? Well, the short answer is beta slippage, where the triple leveraged product is actually going to be 3 times at a third allocation is actually going to be less efficient than a full 100% of the 1 times Qs. So that's the short answer for you. Let me try. Yeah, right there. Boom. That's why it was so fresh in my mind. Go to episode 91 on the website, and you will see we actually compared these two. I'm sure it's this one. Yeah, we were talking about the beta slippage between these two. There's another really good one that was literally talking about the NASDAQ. This one. That's good. I'm terrible at YouTube thumbnails and titles. Even I made the video. I did the live stream. I sometimes have a difficult time finding them. But surely this is it. So go to beta slippage with leveraged ETFs. Yeah, here we go. We're on to something now.
Back to their desired.
There we go. So in this one, I'm sure I was comparing the 1 times to the 3 times. Watch that one because it's a good, 20-minute presentation. You're going to get a much better answer than I gave now. But the short answer is, while you'd think that that would work, that the extra 5% from something like SHV or Box, if you don't like dividend distributions, then you can just hold that. You'd think that that would cover it, but it actually doesn't. The triple leveraged at 1/3 allocation is worse. And the same thing applies to something like SVXY and SVIX. You'd think that our strategy uses SVXY, right? The 0.5 leverage. Well, why don't you just use half your money and then go ahead and use the SVIX? Find something else to do with the other 50% of the money. Yeah, no. I've considered it. I've run the numbers. I've done all that stuff. It's just, it doesn't work out. You're better off just using your money for the intended purpose, and whatever 5% free cash you can get in those short-term treasuries is not going to cover it, not even close. Now we're getting into something. Now we're getting here. Okay, I should have read both of them. Follow up to what you said, stock replacement on the Qs in that scenario and put the rest in SHY or SHV or BOXX or any of those. Okay, now you're getting into something that now this is a somewhat of a different trade. So for everybody watching, if you're interested in what he's saying with stock replacement, I suppose this is a little bit of a shameless plug, but we actually do have a course in our community. It's not just trade signals. There's multiple courses as well. There's a course library. One of the courses is like I was talking about. There's a course here. It's this is our tactical volatility. Remember we were talking about this? There's 19 lessons here explaining everything with the strategy and why we don't use certain ETFs and trade frequency, performance, all the things you'd want to know. That's in there. The Iron Condor strategy, this is 30 videos. So this one will take you, 5 hours to get through, but everything you need to know about Iron Condor trading is in this one. This one is the volatility trend, which is our VXY broken wing butterfly strategy. Again, from our second segment today, I said how awesome butterflies are. This course will teach you all about that. And here's one for stock replacement. So what stock replacement is using underlying options to simulate the ETF. So you could do it in a risk reversal form, which also works very well. It's just more margin intensive, and it's also requires some, certain accounts can't do those things. So what we do is just straight up long put and call options, always open during mid to low volatility, so we don't run into that Vega problem. But yeah, and now you're talking about a slightly different trade because they're so capital efficient, right? Long call options open during mid to low volatility on the Qs will actually save a significant amount of capital. And with options, there's no beta slippage. But what there is options are a freely traded market. So while the stock replacement strategy does get very close to mimicking the underlying, there's no possible way to make it a literal mirror of it. So there will be times when you've got your gamma, your delta, vega. They're all moving around a little bit differently. And there might be times when it slightly underperforms, slightly outperforms. So there's no way to say, well, I'm going to do this to get that 5%. It'll never be a number that you could be consistent with. But yes, if you wanted to do that. Now, I will also say as a last point, and if you've gone through the full stock replacement course, there's a lesson about this. If you're doing the Qs, you need a big account because stock replacement is actually relative to the size and price of the underlying ETF. So if you're doing stock replacement on VXX, which typically, not always, but typically trades at about anywhere from say $8 to about 50 or 60, typically it can spike up and do its thing, but very efficient. Small accounts can do it, no problem. But the Qs, the SPY, things like that, you're talking about $400, $500. One option contract is going to be quite expensive. So this is just feasibility-wise, it's not going to be doable either because you can imagine how inefficient it's going to be if you don't have an enormous account. The difference between if you're buying the Qs, the difference between 100 shares and 101 shares, you won't even notice that. That's a rounding error. The difference between one option contract and two option contracts is an insane inefficiency that you will have to overcome. You will have to trade and build your account and keep going for a long time until you can tick over from one contract to two, right? It's not efficient at all on smaller accounts. So if you've got $1 million, $2 million, sure, you could make it work. If you've got a normal account size, I don't ask any personal questions about our community, but I would take a, wild stab that our average subscriber probably has, low six figures kind of thing as a community average, 150,000, something like that, 200 grand maybe as an average. Some people are at 25 or even 15 or 10. Some people are multiple millions. I don't know which one you are, but stock replacement on the Qs, hopefully you're leaning more on the seven-figure side of things. Okay. With roll yield so high and the elevated M1 future, how could we take advantage of the potential vol crush down when the VIX option expires? I would do it with options. I don't know if you've noticed or not, but our tactical volatility strategy is still in gold. That's just because there's some metrics, for example, the VX30 to VIX roll yield, flashing green light, no problem. It's high enough to go. But there are other metrics like the adjusted M1 VIX futures, for example, but there are others that I track that are giving mixed signals. So we've actually been in gold. Now, fortunately, it doesn't always work out this way, but you can see that we've been in gold for quite a while, since July. This is the SVXY. We've been avoiding this stuff, and we've actually, gold disappoints a lot. It really does. But for our purposes, we entered gold down here on July 24th. We exited a little bit here for a little bit of a whipsaw, but yeah, we basically were just riding gold up and doing pretty well with that. But yeah, we've just stayed in gold for that reason. Now, if you're trying to do it, you got to remember that the reason that future is elevated so high is because of the election, and the action future is the one before the election. So, you gotta be really careful with how you do this. If you don't structure your trades right, you really could walk into something pretty bad. And another thing you want to be hyper careful about, this trips up a lot of people, so fair warning for everybody. If you're trying to do the VIX options, just remember that VIX options settle to the VIX futures. When you're trading a VIX option, you're not trading the cash VIX price. For example, I had somebody email me just about an hour ago before I went live. They were saying that they were purchasing a 15 strike or a 17 strike VIX put option expiring in about 3 weeks for like 30 cents, right? So you think, well, hold on a second. A VIX option, a put option for 30 cents at the 17 strike, well, isn't it already 70 cents in the money? I mean, how is this not just free money, right? I should just load the boat on this thing. But the problem is the front month VIX future is sitting at 1875 right now, and that's what the contract is actually reflecting. So there's a lot of people who might be thinking, oh my God, I'm trading VIX options and I'm getting this insane action here where I can go 16 days out. Look at this. I mean, I can buy a 17 strike for 34 cents. The VIX is already at 1594. I'm already made 70 cents. All I got to do is execute this trade. If the VIX stays where it is, I'm gonna 3 times my money. This is the easiest thing in the world. Well, no, it's not, because the actual underlying is sitting at 1880 and it has to go to 17 just to break even. And actually it has to go to 1670 to cover your premium. So that's what's happening there. And I would say the same thing for you. There's nothing wrong with playing one of these events. But you got to remember that, first of all, the vast majority of people are already positioned. So I'm not going to say you missed the boat. If you're a very astute option trader, you can see opportunities even after the market has positioned itself, but it's harder, right? This stuff was building months ago, and now we're coming in and saying, okay, there's going to be vol crush. Well, they knew that 4 months ago, and they already got all the good option prices. So now is a little bit late to the party to be trying to play the election, so to speak. And don't walk into anything. Make sure you know little things like that the VIX futures actually, it's not the VIX, it's the VIX futures. You understand that VIX futures and VIX options are not the same thing. And you understand all these little intricacies. You understand that Vega is going to crush like this, and that's going to mean that the gamma builds up very quickly as it expires. All these little things. If you cover all your bases, there's money to be made. But this is when I get emails from people saying, I did something, it seemed like it was easy money, I don't understand what happened. And then we do an autopsy afterwards, and I point out, well, you got hit by this, and yeah, it's too bad you didn't know that. And people end up losing money. So be very careful playing the election. Keep it small, I would say, because it's one of those things too where if you're asking the question, I'm not saying you don't know everything, but the fact that you're asking the question, maybe you're not ready for large trades, right? Just keep it in mind. There's a lot of blind spots. Options is not something that the regular retail trader is playing in. So, it's a really stiff competition in the options market, and especially when you're talking about options layered into the VIX products and the volatility complex. you're talking about sophisticated investors for the most part. There are some tourists coming in that just heard about the VXX or UVXY. They follow some guy on Twitter who said that the UVXY is easy money, and boom, 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 there you go. There's some tourists doing that. But for the most part, you're competing against very sophisticated hedge funds and traders and quant outfits that they know all this and then some, right? You're competing against me, right? You're competing against all the people like me who, we have been doing this for 2 decades. So be careful. Options within the volatility complex and futures trading within the volatility complex, you're not trading against dummies. It's hard to make money in those markets. Also, Bear Stearns collapsed much earlier in 2008. Yeah, Bear Stearns was really early and it freaked people out, but it was really the September stuff that just sent it off a cliff. But it was a very strange year where things were looking bad, but nothing fell out. And then all of a sudden, right? We saw the opposite in 2022 where things were looking bad, but nothing fell out. And then the all of a sudden went the other way, right? Market shot up to all-time highs again. Do you take questions outside of the live stream format? Yeah, sure. Email me. Comment section on the YouTube. Like if you can't stick around, like I think that's probably what you're thinking is you just can't stick around for your question to be answered. Either post it here and it'll get an answer and then come back and watch the stream over the weekend, or just leave an actual comment, like wait an hour till the stream's over and it becomes an actual video, and then post your comment there. I answer all comments, but VolatilityTradingStrategies@gmail.com. You can email me your questions, and there are times when I can fall behind on my emails a little bit, but I answer everything. So I still spend several hours a day answering emails. What is your exit strategy on QQQ Iron Condor if the 515 strike goes in the money? Very unlikely to ever go in the money because we use a 50% stop loss and a stop gain. It's going to hit one of those two before it hits one of the strikes. But on the odd chance that it did, nothing. That is not a trigger for anything for me. I don't even look at, well, what am I waving my hands around for? Let's just go to the actual trade. So here's the cues. We've got this trade open. It's roughly flat, a little bit down. Just remember, and you would learn this if you go through the options, the Iron Condor mega course, but when you're sort of approaching the far right side, this isn't actually a trade that is in that much trouble. You have to remember that I was really harping on the Vega aspect when it comes to the long VXX put option, but the same thing applies to Iron Condors. This is a short Vega trade. So the higher this goes, the lower Vega goes, which the more profit it makes. So I'm not saying that it wouldn't start getting into trouble here, but this pink line will actually be gradually ticking up the further it goes this way. The further it goes this way, it'll be ticking lower. So if a trade was dead center right there, that's not actually a trade that is dead center as far as probabilities go. A trade that is maybe here-ish, I would say is a 50-50 trade, right? Always on this side, because this is where the Vega starts building up high and kills you. But anyway, your question with the price right here, what happens if we hit the short strike? Well, absolutely nothing. My trigger is the premium that we collected for the trade, 50% of that premium. So either 50% up or 50% down, we're going to hit one of those. Somewhere here, we're going to hit the stop loss. I would anticipate maybe here-ish we'll hit a stop loss. Or if enough time goes by, maybe 3 or 4 weeks and nothing happens, then we're going to hit the stop gain. This pink line will just gradually tick upward and our profit will come in every day because, of course, they are theta positive trades. Every single day we are making a little bit of money as we're just sitting waiting for the market to make a decision. And so right now everything's completely fine. But if it did start going this way, the stop loss is our trigger, not the structure of the trade. Remember, that shape of the Iron Condor, that is the expiration shape of the trade. That's what it looks like at expiration. But we trade 45 to 75 days out. We use a 50% stop loss and a stop gain. And within 30 days, we close the trade and move on to a new one anyway. So that shape is totally irrelevant for our trading. means nothing. We will never get to expiration. We will always be closing out at least a month before expiration. So just calculate your premium that you brought in for the trade. Can't remember what it was offhand, but let's just say it was $1.20. If it hits $1.80, you close it for a loss. If it hits 60 cents, you close it for a gain. That's what you do. You just track that one simple number. Iron Condors don't have to be complicated. Just very easy. We've got a set of about 10 hard rules that we follow, and pretty easy stuff. Just look for the 50%. And of course, I'll send it out in the daily email when it's time to close it, so no problem. When selecting strikes for an Iron Condor, are you using TA like fib levels to determine where to place the strikes, or delta, or some other combination? Yeah, you could learn all about this in the course. I hate plugging stuff, but it's just so relevant. This is a 30-video Iron Condor course, so let's just do a little sidebar plugging of my business here, because you didn't hear it from me. All right, I'm not supposed to be saying this kind of thing, but you can see that every subscription does come with a free 2-week trial. So I would suspect that, wink, wink, if you were to sign up for the free trial, I would imagine that 2 weeks is enough time for you to get through the Iron Condor course. And then if you wanted to click on subscribe and not pay me any money, you could certainly do that. Or, some people stick around for a couple of months and then they move on to something else. Most people stick around for years because I'm basically just giving the portfolio and all the trades, and people don't dive into these things. But for people who tune into my live streams, typically they are more of the active trader types, the ones that really want to learn, they want to ask questions. For them, you should definitely take the free trial. If 2 weeks isn't enough time, certainly 2 or 3 months will be. I will not be offended if you, unsubscribe in 3 months. It's completely fine. But that's what the course is for, to teach you stuff. So let me answer it. Basically delta. We use roughly 15 delta on both the put and call side. And then I just go into the product depth a little bit, and sometimes I choose the right strikes. Usually you're going to be within, the 16 and the 14 delta, or the 13 and the 12, and you basically just have to pick one. And there are ways to be slightly more efficient. You can dive in and just make sure you're selling the one that's slightly higher and you're buying the one that's slightly lower. Again, it gets into the Vega. Options across the board, it's not price prediction. It is efficiency of selling things that are overpriced and buying things that are underpriced. So you use the roughly 15 delta on both sides to get a general gauge of where your trade is going to be, and then you get specific into fine-tuning, selling the strike that's a little bit more elevated than the ones next to it. And you just, that little efficiency in trade fees, little efficiency in layering your trades, little efficiency in mentally handling trades well and not panicking in a crisis. You get 5 or 6 little edges, and it adds up to a very successful strategy long term. There's nothing that's just going to be like, wow, I just did this one thing and now I'm making 30% a year. It's little tiny ways that you can just learn little things that make, 10 small things add up to quite a lot of money. Was the VXX Broken Wing Butterfly you recently posted meant to be a debit trade? I had it as a debit. Well, mine's a credit. Screen share, but a very small credit. Mine's a credit. Trade in question is this one. So you can see mine was like a 2-cent credit or something. You can see that this line is just barely above the break even. So VXX is trading over here. Of course, we do want it, by next week to be approaching over here somewhere. But, if it doesn't, there's no loss. I always like to just throw a bunch of these on. This is for people, following along, they're wondering what's going on. It's basically a 0% overlay. It doesn't cost us any money to do this because we've got plenty of not margin, but available actual cash in the portfolio. So we just throw on these 1% trades just like this. But if yours was an 8-cent debit, that's not out of the realm, but I would say that's certainly extreme. This is one of the things that people just get so frustrated. And I'm not saying you do, but I should just let everybody know that This is going to sound bad, right? It always does when I explain it in emails. People don't understand because they're always the one asking the question when they were on the wrong side of it. But you have to understand that intraday pricing is best viewed as like a bell distribution. My trade got 2 cents. I guarantee you there were people in the community that got 7-cent credit, 6-7 cent credit. And unfortunately, I hate to break it to you, there were people in the community that got 8-cent debit, right? That's you. So now you're the person that was on that extreme. You imagine the bell curve, 68% of the people are in the middle here, and then you got the edges, and then you got the extremes, and there's like 3 people on either side that are just, one person's wondering why this trade isn't like, it's going great. Like, this is amazing. I got an 8-cent credit. Other person got an 8-cent debit, and they're thinking, well, I'm kind of down. I'm already looking like this is not going well. Unfortunately, that's trading. And whenever I say this, again, because I only ever have to explain this when people get a bad fill. Nobody ever emails me and says, hey, what's going on here? I got way too good a price. Nobody ever does that. They only email you when they got a terrible fill. And unfortunately, all I can say is law of large numbers. This time, it does sound like you kind of got screwed. There was probably some type of intraday noise. I send the email at about 11 a.m. By the time 4 p.m., you've got a community of 1,000 people entering trades within a 5-hour window. Bell distribution. Some people are going to be very happy. Some people are going to be very disappointed. But the more you do this, next time you might be on the good side. You get a couple where you're in the middle. And all of a sudden, law of large numbers, none of this matters. But over short periods of time, like we only take a trade or two a month max. So you could get periods of like 6 months where you just got consistently bad pricing and your performance is lagging where it should be. And other people get consistently good performance for 6 months and they're like, what's this guy talking about? 2022 was always just such a standout year for me because I did have a losing year. But of course, because of the way intraday pricing works, there were people that did significantly worse than I did, and they're really mad. But there were also people that were emailing me like, I heard you talking in your live stream. You sounded pretty negative about your performance, but I actually did pretty well. I don't know what you're talking about. So there's probably like a 10% bar that you could stretch it out beyond what the dead center community is getting. And there's no easy way to break it to people. You will get times where you got the worst fill price of the day. You just absolutely bottom ticked it and you think, well, if I just waited an hour, I'd already be up money, right? It just, unfortunately, 8 cents is, that sounds like a very extreme bad price. I am sorry that happened to you. Butterflies, VXX, normal days. I think I just lost my light. I'd say about 5 up, 5 down is normal. I don't know. Maybe my 2 cent credit was the good side. I have no idea. But I was assuming that it's in the middle. Maybe it wasn't. But yeah, there's a good 10 cents spread there. Sounds like, sorry about that. But your trade's still fine. It's just 8 cents. If the VXX doesn't go down to the, the mid to low 40s, you lose 8 cents per contract. Okay. Thanks for the content. I'm overwhelmed by the content and have so many questions, but my knowledge is still so slow. I even cannot formulate any question. Okay, well, that's good. You dipped a toe in the question asking pool here. You come back with a few next time. No problem at all. And again, I always have to remind people, but first of all, this stuff isn't easy, right? Hopefully I'm reasonably good at my job and I can explain things in a way that, I hope I make it sound like it's not rocket science, but this stuff isn't easy. So if you feel like you have a question that, oh, this is probably a dumb question, it probably isn't. It probably is something that a lot of other people are wondering. So, obviously ask your questions. But secondly, it gets back to what I was saying before. You have to learn how to be selfish and just ask your questions. Like worst case scenario, I could either punt on it or I could just answer it simply, or I could just chuck you off, say, hey, watch this video. It's perfect for you. But yeah, come back with questions. Regarding stock replacement, instead of expensive long call options, how about using a slightly out of the money call debit spread? Aha. They're much more affordable and the spread neutralizes the effect of theta and vega. So what do you need me for? This is exactly how I would have answered the question. Of course, when you're talking about a long put option or a long call option, there is nothing more Vega exposed than that, right? That is just as long, net long Vega as it gets, right? But what happens if you do a delta-wise, a directionally positive trade, but you also throw in a short strike, right? So a long call spread being a long call and a short call on the other side of it, like you said, I mean, you don't need me here. You have basically, not completely, but you've largely reduced the impact of that Vega. Now, it depends how wide your strike is. If you do $1 strikes on something, then you've basically neutralized it. But if you do something like on the Qs, if you did like a 500 and then a 550, like a pretty big spread, which sometimes I do, there are reasons why you would want to spread that out. I mean, going $1 on the Qs is going to be crazy for contracts, but then you're not eliminating it because maybe the short is going to be significantly weaker than the long. But yeah, you're absolutely right. You answered it. Absolutely. If your brain clicks to, hey, I need to do a long put or a long call, ask yourself, is volatility high right now? If it is, try to make it a spread, try to make it a butterfly or a calendar if you can, something, an Iron Condor or whatever it is. For us, for our stock replacement, when we are trying to replace the VXX going down, we can buy long VXX put options because we only get the green light to enter short vol when it's already mid to low. So we don't, I mean, it's not the lowest Vega gets, but it's largely eliminated at that point. So we can go ahead and do that. But on the high side, if you were to do stock replacement on the market crash signal, you can't buy a long call option on VXX. It's just, you're buying into a massive Vega headwind if you do that. So you turn it into a spread, just like you said. And then what I like to do is just spread those strikes out a little bit just to sort of reduce contract size, but also introduce maybe a little bit more profit potential. But yeah, you said all that in one sentence. It took me, several minutes of ranting. This is why I need VTS options back up. I'm trying. I've got some things to teach. I think people will be, this time around, the reason that I had to shut it down is just because my emails were absolutely overwhelmed. There were a significant number of people in that community. And when you get, I think it capped out at about 620 or something. When you get 600 people, options are complicated. And I had just an unbelievable email burden that I just couldn't handle. So my idea for the next time around is to already have pre-made like 5 or 6 courses with several videos all ready to go. And then I think a lot of that initial email burden will be cleaned up. So it just takes a long time because I'm pretty detail oriented and I want to make sure that it's good, like it's my best work. And so, yeah, I got to produce 100 videos behind the scenes. I've got lots ready and I don't even get to release them, right? I feel like I'm working 12-hour days forever, but I'm just slow trickling, like a video on VTS a week, a live stream a week if I'm lucky, a couple articles a week. People are like, this guy says he's working 12 hours a day. Yeah, 6 hours a day of emails, 3 hours a day of making VTS options videos that nobody has seen yet. Yeah, I'm working my ass off, but it might not show up in the public just yet. But there will be a time when I will just say, here we go, enter, click, launch, and then you'll see where the work was. Oh, hello, we're still going.
Okay.
Yeah, it's 1:13. I'll wrap it up here soon. Wife just got home from her wine party, so I reminded her before she left, when she comes home, that I'll be live streaming, so don't open the door. I take that she opened the door and she probably drank a little bit too much. Is that what happened? All right, let's wrap this up. Yes, but synthetic long is more margin intensive and less capital efficient. So you're answering somebody else's question. Good. You answered your own. You didn't need me. So maybe you should be a moderator on my channel. Liberty, has your email changed? I sent a message a few weeks ago, but I may have used the wrong email. So VolatilityTradingStrategies@gmail.com is where you want to send all your questions. I should have a little ticker, but I don't. But if you go to the website, there is a contact form that you can do it there as well. So Okay, what time do I run my analysis? It takes about 30 to 40 minutes, and I don't like to run analysis in as soon as the market's open. I leave that sort of early morning chop for the day traders. So I'll start maybe 45 minutes to an hour after the market's open. I will input all my data, and then the email itself is always prepared ahead of time, like, before the market's open. So I just put everything into the email and send it off. So typically, I would say if you're looking for a number, the volatility metrics that you see in the emails are from 10:15 in the morning. And then email typically will go out about 10:30, something like that. The email itself is all like copy paste templates. That's not the tough stuff that takes time. I like to do the full series of metrics. So any Dubai trip story to share? No stories. I'm a boring person, as I've said many times. I really quite a boring person. I had my fun in my life early on, but yeah, in my old age, I'm quite boring. When I'm in Taiwan, I work 7 days a week, but 6 days a week I don't do much. And then maybe a night or two, wife and I will go out. We went to an awesome wine tasting, like Michelin restaurant yesterday, and I think tomorrow we're doing something else. She keeps coming in. Yeah. And then when I'm in Dubai, I think I'm even extra boring. When I'm in Dubai, I'm basically just working out, running, working, just going back and forth between at my desk and either in the gym or running. I don't do a whole lot. Maybe golf. I have a golf membership. I have 3 golf memberships, but I don't use them. Used to golf. I don't really golf anymore. Yeah, I'm pretty boring. Eat the same food every day. I go to the same places. I work the same hours. I sleep the same times. I do the same things. My life is extremely structured. So I wish I had more stories. Would it be helpful if the daily trade post you mentioned, let me try to read English, mentioned if trade is to be a credit or debit unless they're all meant to be credits. I don't trade debit trades, so no loss on the VXX trade. So what you're saying is, when I send my email, should I let people know that it's supposed to be for a credit? No, that's a disaster. I used to do that. And I used to also send my trade price. So whenever it was options, this was several years ago, but I used to actually take a model trade in the account and then show people that trade. And of course, I didn't think this through until I learned with a massive email burden what ends up happening is if people don't get that price, the first thing they do is email and they're asking, well, what's going on? And I have to explain, well, the market's intraday, prices are bouncing around. You might get 5 cents more, 5 cents less. Don't worry about it. Just take the trade. It was a nightmare. So what I like to do now is just throw out the trade, give the details, the instructions, and just say that's the trade for the day. This Iron Condor, these strikes, that expiration, this allocation size, take the trade, right? If I say, take the trade, it's supposed to be $1.21, and you're only getting $1.14, well, you're either going to skip the trade because you think there's something, you shouldn't take it, or you're going to email me, and then you're going to be sitting by your email waiting for my answer for a couple hours before you execute your trade, and you're going to be stressed out, and then I'm going to be overworked, and the whole thing's a disaster. So just take the trades. Law of large numbers, you have to have confidence that it really is going to be 50-50. Unless you just get an unbelievably bad string of luck in your life, you're going to have some good ones and some bad ones. When I'm trading, I don't even look at what I could have gotten an hour before. I don't even think about, well, what might it get to if I wait 30 minutes? Or I wonder if I could get 10 cents more if I just waited here. Or, you put your price in and you can see the mark is 1 penny different. I don't really wait. I just wait 30 seconds, adjust it, and move on. I just get my trades done and move on. Law of large numbers is something that you just have to understand will be true the more you trade. So just do it. I don't have no problem with you saying that you didn't take it because it was a debit. Fine, I guess, but some of our trades are for 20-cent debits. Some of them are for 30-cent credits. It's just all over the map, right? It's just the trade itself based on where the rest of the portfolio is. That matters quite a bit. This is the only strategy that takes influence from the other ones. But the reason that we do this is, of course, a broken wing butterfly, it can only really lose money, significant money. I mean, yours can lose 8 cents, but significant money all the way down at 42. Well, I want to make sure that if that happens, I'm going to lose 1% of my portfolio on this trade if that were to happen. But if the VXX goes from 49.50 to 42 in 1 week, well, I guarantee you the rest of my portfolio is going to make a lot of money. So that's why we do it. But sometimes to get that trade done, I moved a window here. To get the trade done, it's a 20-cent debit. It's a 10-cent debit. It is what it is. I wouldn't have a hard rule like that it's really quite arbitrary. Like, I don't do debit spreads. Well, then you're going to miss a lot of the good opportunities, because option trading isn't about whether it's a credit or a debit. An option trading is about, is 8-cent debit efficient and is it cheap, right? Is a 10-cent credit expensive? It might say 10-cent credit, but that's a terrible credit. It should be 20. And it might say 8-cent debit, but that's actually a really good price because it should be 15, you know? I wouldn't use arbitrary rules like that. All right, there's one more question. I think maybe two more. What's your take on running a weekly wheel on NASDAQ or individual stocks? Have you done any backtests on the wheel strategy? And what are some thoughts on risk to consider? I don't really backtest the wheel anymore because I started doing this like 15 years ago. So everything I do is just, I have so many layers that when I get an idea to test something new, I just throw 25 grand and I just test it for a couple of years live trading. I don't really do backtests anymore. Haven't for years. But I don't like doing the wheel as much on individual stocks, to be honest. Technically, works the same way. It's just on the reverse. But there's just something about VXX and UVXY that I personally, and some people have told me that they are actually the opposite. They're not comfortable with it. But I'm actually very comfortable holding those shares and just selling the aggressive covered calls. I would much prefer that than the stocks, because I know eventually the VXX is going to get me out of it. And I don't hold my covered calls at the strike that I got in or got assigned or whatever the case may be. Sometimes I sell them for 50% loss. But because I've collected so much money going down, it's actually a gain on the trade. So again, no hard rules on arbitrary lines and anchor bias and all that stuff. I don't say, well, I got assigned at 20, so I can't sell the covered call for less than 20. 6 months later, my covered calls might be for $8, right? It might go down that way. But I'm perfectly comfortable tracking it all the way down. Other people are not. Other people have said that they're more comfortable doing it on stocks and ETFs and indexes. So if that's you, if that's your personal style, it's technically the same system, right? I just think that especially when you consider the fact that our portfolio is, and almost everybody in the world is typically net long equities, net short vol anyway, having something that's the inverse of that you're rolling down, there's just something really comfortable about that. It's really mentally very easy to handle a losing wheel trade on the VXX because you know the rest of your portfolio is doing great. That's a really comfortable situation to be in. So I basically only do the wheel on vol ETFs. All right. There's one more. Given the October VIX futures is not quite in contango, but the markets are going up, what would the reason be for that? Well, the election. The futures are just kind of a mess right now with the election pricing. I don't think it means a whole lot for the volatility ETFs because they do use a rolling 30-day contract, so everything is kind of smooth and there is roll yield there. It's just there's a lot of hesitation, right? There's not going to be any vol crush until we get some resolution, right? There has to be some reason for that to be sucked back out of the market. And right now, as we've seen, the S&P 500, maybe not as of today, but slightly below all-time highs, but the volatility ETFs, not even close, right? There's just no reason for people to vol crush right now. Like it's just, I don't front run. I'm not out of SPXY because I'm anticipating trouble for the next 3 weeks, but it would be surprising if the SVXY launched higher. Whereas, again, I'm not in gold because I made this prediction that gold would do better. The metrics put me there, but they're correct, right? There is a reason why gold might do well in this type of environment. And there's definitely a reason why the VIX futures are just going to be all over the map here, because the October future is going to be way different than the November future, right? And the September was getting skewed and everything is kind of carrying. So you're going to see everything sort of go from very uncertain to normalizing within a day or two, probably. It's just going to all go back to normal after the election, or once we get something definitive, right? Right now, this stupid election and these, things made so much more sense when it was Biden versus Trump, right? In that case, we all knew that it was over, right? It was done. The election's over. Why even go through the motions at that point? And then everything just changed as soon as Biden stepped down, which I always thought it was amusing. I know I'm not supposed to talk about politics, but I do get a kick out of that the Republicans were, and I apologize if you're, I don't want to offend your team, your flag, but your color. But the Republicans were just adamant that Biden has to step down. He's a disaster. He's, got to step down. This guy can't even speak. They were all over the news talking about how, can't you guys see this? This person, this guy's a houseplant. He can't do anything. And then he stepped down, and now they're like, well, this is a constitutional disaster. You can't step down in the middle of an election. It was just hilarious spin there. But it seems like a dead even race at this point. I even actually have some stats. This is going to be fun. Let me get myself into trouble by talking politics. Fortunately, at the end of a stream, most people have ducked out, but where's my screen share? This is what we're looking at. This is interesting to me that these are just the swing states. Nationally, I think Harris is up by about 5 points, which is basically what generic Democrat does over a Republican anyway. So that's a close race. If a Democrat's up, 4 or 5 points nationally, that's kind of considered a tie. And here are the swing states is basically considered a tie. So at this point, I don't think the SVXY is going to have a difficult time catching any momentum. Just think this election is just so uncertain. And I know all elections feel like the stakes are really big, but this one does feel like the stakes are kind of big. I'm actually personally, just on a personal level, I don't know where everybody else's head's at. I'm actually a little worried what happens if Trump loses. So I'm not saying I'm endorsing anybody or I'm part of any team. I'm Canadian. I don't even get to vote. I'm out of this stupid thing. And I just think your election cycles are just comical. They're so long that you're constantly in this election mode. It's election now. And then as soon as that's over, it's, let's take a break for a month, and then we got to talk about the midterm elections coming up right after that. And then, after that, well, who's the next presidential candidate? And we just keep going and going and going. It's comical to me, but I am quite concerned this time around what will happen if Trump loses. So I guess just out of pure United States self-preservation, I am hoping that Trump can somehow pull off a surprise victory. He does seem to be losing, though, so... Yeah, boy, you'd hate to predict violence, but it does seem like there's probably a tipping point of just enough people who think that the election would have been stolen if he lost to have a little bit of reason for concern. Whereas on the other side, I just don't think that that's a very plausible thing. Obviously, there's some radical groups on the left as well, but I'm not nearly as worried. Like if Trump wins, I don't think there's going to be a left revolt. If Harris wins, wow, there's going to be a lot of pissed off people. There's going to be a lot of people who think that that it was stolen. So let's leave it there. Hopefully I just sufficiently got myself into political trouble. I'm not on any team. Remember, I'm an equal opportunity offender. I hate all politicians on both sides. I think they're all incompetent and selfish and self-serving and stupid and unelectable, and I don't even think they're in the top 50th percentile of valid people to be running a country, let alone the very best we've got. I mean, if anybody looks at Kamala Harris and says, hey, there's 220 adult Americans in this, eligible age adult Americans, 330 million total Americans, I think that's the best we've got. I would seriously question your sanity if you thought that that was the best we could do. Top 50th percentile even is a stretch to me. I think you could go outside and throw a rock and hit the very first person would be a better president. But what do I know? What do I know? Who cares? All right, let's leave it there. By the way, the same applies for Trump, so don't get it twisted. All right, cool. We'll do it next week. And think about a couple new topics. Thanks, everybody.